Julie Hyman and Adam Johnson. Also, trader Michael Gurka of Neural Markets standing by live at the Chicago Mercantile Exchange. Also with us, Ted Parrish, the Director of Investments at Henssler Financial Group. He joins us from Georgia. Ted, let's kick things off with you. So, Legg Mason's Robert Hackstrom just saying stocks are pretty cheap. Do you agree?
Yes, I happen to agree. I think that we're in a really robust earnings cycle right now, and the earnings for 2010 are really high. And based on those earnings, which I think the stocks in the S&P 500 will hit, the market's pretty cheap. It's lower than this 20-year average PE ratio. And then you got next year's earnings that are shaping up to be pretty well. So, yes, the markets are cheap.
Ted, is the Fed keeping interest rates low for an extended period of time? We got that from the Fed today. I had an earlier guest, Dino Coase, who says we might not see the Fed raise rates for at least another year. So that low rate environment also kind of helped the equity markets here, in your view?
Yes, it does help the equities markets, but I think at some point they're going to have to increase rates, which may not hurt stocks very much in the near term. But longer term, they're definitely going to have to increase rates. Stocks are in a good position. I mean, their balance sheets are pristine right now. They've refinanced a lot of debt, so they're in a great shape to do well going forward. Acquisition activity is up, and I think low levels of interest rate actually help that.
All right, I want to get to the heart of some trading action today. Michael Gurka, I want to bring you into this conversation. I watched the S&P when the Fed statement came out. We got a kick to the upside. We pulled back, and now we're back towards those highs. What do you make of the trade we've seen coming off of that Fed statement?
Well, I think what happened, first of all, was the expectation was that we would see no news. And since we got the status quo, it's full steam ahead, just like our guest just mentioned. For the same reasons, just on a technical perspective where traders look at, I've been looking at 2-year weeklies for a while in many different markets. And on our retracements, on a weekly basis, 1144 was a big settlement last Friday, which we exceeded. You know, I'm not going to jump to conclusions here, but my next level is 1257. And with a low interest rate environment and really no head fakes in the nearest scenarios, I feel as though our expectations can continuously drift because the headwinds are diminishing. And right now we have a lot of clean balance sheets, and our earnings have been showing that. So I'm somewhat positive on stocks at this level, even after this nice gain we've had this year.
All right, so Michael, you've got 1257, so about 100 points. Ted, you've got an S&P target of 1315, so that's about a 14% move from today. What about, though, Ted, some of those headwinds, whether it's housing? Housing continues to remind us that that's a big problem.
Yes, housing is going to be a big problem. I don't think we're out of the woods yet. I mean, there's still a big wave of resets for adjustable rate mortgages from 2010 to 2012. But if we get the housing market just back to a level where it's not subtracted from GDP, I think that'll be a benefit for the economy. It's going to be a business-led recovery. I think that businesses have to spend to rebuild some of the capacity, and I think they also will start hiring soon. So, you know, I do think that, the companies are in great shape.
All right, so we're talking with Michael Gurka of Neural Markets and also Ted Parrish of Henssler Financial Group. I mean, Ted, interesting, this GE news, like I said, it caught all of our attention here. I mean, you want to see these companies bringing back their dividends.
Yes, I do. I actually own GE, and I think that GE Capital that's the whole story with GE. You know, the stock's trading at a point where, you know, GE Capital is being given away. I think the industrials business is worth about $20 a share. It's good to see that GE Capital is actually stabilized, and I think a lot of that does have to do with the commercial real estate market in the UK. You know, pricing has gone up a bit for some of the CMBSs, and that's a good thing. I think that Jeffrey M.Elt, on the other hand, has done a great job in managing this company through this cycle. He doesn't get enough credit as far as I'm concerned.
Hey, you know, Michael, what do you think about that and companies reinstating their dividends?
Without question, there are new ways of devising growth in this environment. And again, I think it all stems back from a year ago when not necessarily we just had toxic assets on the books, but how we were going to start to either refinance debt or how we were going to start it turning into other ways of making money for firms. And right now, at least, it's the stability of the balance sheets to really start to grow forward. And I think right now, leaders in technology, which GE has so many different arms in those areas, is almost a differentiating scenario. And that's one of the reasons why you're going to see the GEs of the world perform very well in this environment. And for the same reasons, I think the demand in the marketplace for the U.S. to be a leader will be exemplified by companies like GE. One of the things that Bloomberg did state earlier this week, which I believe in, is some of the thoughts from some of your guests about how emerging markets are really underperforming as far as investment, and that they look for that to continue and outperform most of the developed countries as we go out through 2010. And I think that's a direct reciprocant of why these companies will perform well. We know that GE is a global company and they're everywhere, but for the same reasons that Brazil, Taiwan, South Africa, and of course even Canada will perform well with those commodity type of scenarios. I think that there's going to be a lot more growth in those areas on days like today when you see such a spike in commodities like gold.
Our guest, Michael Gurka of Neural Markets, Ted Parrish of Henssler Financial Group. I do want to, though, go back to something, Michael, you said about, I think, the U.S. leading. I mean, Ted, you agree with that the U.S. will be the leader here?
Yes, I do. I do think U.S. companies will be the leader. If you look on, I think the stocks in the U.S. are cheaper and in a much better position to compete globally. You know, that says a lot. I think that the companies are well run. Capital's been cheap, and their balance sheets are in good shape. We particularly like industrials. We think that the whole global infrastructure build-out picture is still bright, and that U.S. companies are going to take advantage of that. And that's, you know, what's going to lead this year is industrials.
Michael, you're watching the trading action. Where do you think the leaders will be in the market for the next 6 months? You expect gains, so where do you think they're going to come from?
Well, you know what? About 4 or 5, 6 months ago, I really believed in the fact of infrastructure because there is so much government money out there, and at the same time, I think it's such a global marketplace. A lot of our infrastructure companies, on a global perspective, have extremely long webs to cast. But right now, at least, I believe it's technology, and I will reference your guest right there. You know what? Sam Zell has been known, for me at least, in the last couple of years, for one thing always, and that's being ahead of the curve. The man is clearly out there knowing where things move way in front of most as far as speaking about it, and those are the kind of votes of confidence I think that investors like to hear. On the retail end, of course, the institutional end is seeing that, but one of the things I would look at also is the commodity plays globally, and especially in Argentina and Brazil, as mentioned, because you know what, even in grains, they had a great growing season this year while we started getting bombarded here in the U.S. And even though we're talking about this growth overseas, I think it's U.S. demand that's going to surprise, and that's going to show up in a lot of these balance sheets. Again, if you want to look at the technology side, if you had a company that had 50 employees and it's been cut back to 40 or 35,
right,
and you're keeping the same productivity, you're not going to be hiring just yet because you're getting by and you're doing just as well. But when that starts to raise, then you're going to see these spikes in volume, and that's going to be the first sign for us as a market when we start to see that type of play in the marketplace. All
right, gentlemen, I'm going to leave it on that note. We appreciate you walking us through the close on this Tuesday. Michael Gurka of Neural Markets out in Chicago, Ted Parrish of Henssler Financial.